Today, there is more bad news from China. The Chinese economy has slipped into deflation.
All right, so crazy stuff is happening around the world, and we have to talk about
China.
This is not China. This is a deck of cards, but I like to think of China's economy sort of like a magic trick, in that investors have made billions over the last few decades, but like a good magic trick, it's also sort of an illusion. Watch. Come on, that's pretty good. That deserves a smashing of the like button. I will never miss a good magic trick analogy.
China kickstarted a 45-year transformation that took it from a largely agricultural society to the economic powerhouse we know today.
So China is sort of considered to be the miracle economy that the rest of the world relies on for its growth. And now it's slowing down, which will have a huge impact on the rest of the world's economy. And just recently, President Joe Biden said that China's economy is a ticking time bomb.
President Biden adding insult to injury, calling China a ticking time bomb, and adding, quote, "That's not good, because when bad folks have problems, they do bad things."
Now, in that same speech, Mr. Biden said that China's economy is slowing down to 2%, which is actually not true. Instead, China's economy grew by 5.5% in the first half of 2023. And for any other major country in the world, that kind of growth is amazing. By comparison, for example, the US's GDP grew by only 2.2% in the first half of 2023. So hold on, if China's economy still grew by 5.5%, why is that so bad? It's bad because relative to its previous years of growth, it's slowed down by a lot.
Back then, regularly the economy was growing 10%, 11%, 12%. In the second quarter of 2007, the economy here grew 15%. And so relative to that, it feels much slower now.
Now, chances are, if you clicked on this video, you probably don't live in China, so why does any of it matter? It matters because China is the second biggest economy in the world, right behind the US. And whenever China reports strong growth, those effects are generally good for the rest of the world and its investors, because China is the epicenter of manufacturing. Everything is made in China. So when China's economy slows down, those effects are felt as well. Just recently, for example, the stock market went down in the US, all because of China reporting a slower growth than usual. That turned a lot of investors fearful and bearish over what that means, and some of them sold their stocks. And unfortunately, as we've learned in 2020, what happens in China doesn't actually stay in China. So in today's video, I want to show you exactly why everyone's talking about China, what's happening with the Chinese economy, and how this will affect us. So let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for China. So here's the world, and every country in it has the exact same problem, the money problem. Both the US and China have a lot of debt. The United States owes $32 trillion. The first and only time the US was not in debt was in 1835, and that lasted for just 2 years until 1837. For the last 186 years or so, the US has been going deeper and deeper into debt. And believe it or not, 25 of the $32 trillion the US owes was borrowed within our lifetimes in the last 20 years. That's 20 years of tax cuts, recession and stimulus responses, and more spending by all sides of the political aisle. China also has the exact same problem. It owes money. Data's hard to find on how much China owes exactly, but economists put the estimate at about 282% of debt to GDP. That's a fancy way of saying they owe 282% of what the country makes in a single year. The US is not that far behind at 257%. The global average is 256%. So the point is, the entire world has a money problem. But here's where things split off. In the US, the price of everything, groceries, cars, gas, and rent went up. Inflation went way higher than the 2% the Federal Reserve wants to see over these last 2 years. China, though, now has the exact opposite problem called deflation.
Everyone expected consumers would come back and spend, factories would start making product again, and China would once again be the global motor for growth.
That was the expectation, but that's not what happened.
And not good, all right.
China slowing down, of course, affects Asia, affects the world.
Consumer prices went down 0.3%. So hold on a minute. Isn't deflation ultimately a good thing? Don't we want prices to come down? Yes and no. Consumer prices don't come down in the way we intuitively think they should. It would be great if companies started to care about the middle class and started to lower their prices, but that's not how it works. prices come down when there's less demand. And that's bad for economic growth because companies slow down and they make less stuff, which ultimately leads to a country making less money. And this can lead to a range of outcomes, none of which are good. One of the downsides, for example, is that housing values are going down. Just for context, for example, China's real estate industry accounts for roughly a third of all its income or its GDP. Owning and investing in a house in China was supposed to be the safe, guaranteed way to build your wealth.
For decades, China's booming property market has meant that owning a property is a surefire way of increasing your personal wealth. The problem was the crackdown on the property sector, cracking down on how much debt it had, happened very intensively and far faster than the economy could really catch up with.
Unfortunately, here in the US, we've already learned nothing with investing is ever guaranteed, especially in real estate. And you might remember Evergrande's collapse, which was one of China's biggest real estate developers.
Evergrande.
Evergrande, one of China's largest developers, suffered some of the biggest losses. Its founder, Hui Kayan, was once the second richest person in Asia. Then in 2021, his wealth plunged $17.2 billion US.
In fact, Evergrande lost so much money that it was more than what Microsoft or Google made in all of 2022. And that's all partially made possible thanks to something called the pre-sale system, where in China, a real estate developer can start a pre-sale and collect deposits before they start to build any housing units. With that money, they can start to build some of it, but before they complete the project, they can start the next pre-sale and collect those deposits and so on and so forth. And before you know it, the goal becomes not to complete any specific project, but to collect as many of these deposits as quickly as possible. And doing this, they were able to make a lot of money,
earning $73 billion US in annual revenue at its peak in 2020. According to its website, it currently owns more than 1,300 projects in 280 cities across mainland China.
But all of this eventually led to overbuilding, an excess of supply, and it put a strain on people's finances. So much so that the Chinese government had to step in and put a limit on people's borrowing. And since no new money was flowing in, Evergrande eventually defaulted.
Complexes turned into ghost towns, residents organized mortgage boycotts, and a pandemic shook the global economy. The unprecedented crisis exposed the economic vulnerabilities of China's real estate sector.
Now, unfortunately, the worst part about all of this is that China's real estate could get even worse because there's another real estate developer called Country Garden, which has 4 times the amount of projects than Evergrande, and it's on the brink of collapse. They now have 30 days to avoid an official default, which would put China's real estate crisis on a whole new level, and China's property values are already falling and people want to sell and exit their investments. But another huge reason why China's economy is really slowing down is because the population is starting to reverse.
For as long as most can remember, China's rising population has been an economic advantage to its labor force, but that number is now dropping fast. The working population went from 997 million in 2014 to 986 million in 2021. The UN predicts it will start declining even more rapidly in the 2030s through the end of the century.
You don't have the newcomers into the housing market, so the demand is weak. First, population is falling. Second, disposable income is not growing, stagnant. Third, the youth is unemployed to a large extent.
Remember, the US has what's called a tight labor market. There's about 1.7 jobs available for every 1 person willing to work those jobs, but China has the opposite problem for a lot of reasons, like the aging population that's going in reverse, the transitional phase for their economy from agriculture to service and consumption, and of course interference from their government. For a lot of those reasons, there's a mismatch between the jobs available and the amount of people willing to work those jobs. And statistics show that 20% of their younger population is now unemployed.
It hit 21.3% in June. That's 1 in 5 young people between the ages of 16 and 24, and 4 times the overall jobless rate in China.
Some economists estimate that if you factor in the amount of people that have given up and stopped looking for a job, that the real unemployment rate could be closer to 46.5% for the younger population. It's gotten so bad that some parents have started to pay their kids to be full-time children just to stay at home.
There are even some parents now paying their kids to be full-time children, mostly to do housework and be available when needed. as people wait or pray for better days.
And this slowdown in the jobs market isn't just affecting younger people. Older people are left to compete with the desperate younger job seekers that are willing to take a pay cut, and it's gotten so hard to find a job right now that it even has a name.
A phenomenon known as the curse of 35, now making the rounds on Chinese social media, saying that getting hired past the age of 35 is nearly impossible because companies think those employees are less likely to work overtime.
And on top of that, last week, the president signed an executive order to become less dependent on China's economy.
This is supposed to start next year. The order bans new private equity, venture capital, and joint venture investments in chips, quantum computing, and certain AI companies. It also requires Americans doing business in China to report direct investments in those sectors to the U.S. government.
So there's obviously a lot that's going on, and the ultimate question is, if China's economy slows down, is this overall a good or bad thing, and how does this affect investors? I would love to give you my personal opinion, but the truth is, I don't think I know enough about global macroeconomics and foreign policy to have a strong opinion, because I don't think I'm smart enough. I try to make sense in my videos and explain it like I'm 5, but this goes way beyond anything I've tried before. But after doing hours and hours of research, here's the best that I can do. From what I understand so far though, and please feel free to correct me, is if China's economy slows down, the first real downside is disrupted supply chains. Just because of how much the US outsources manufacturing to China, we would see longer delays, we would see things being out of stock, and generally things would become more expensive. It could also lead to China having less demand for US products, and that would have an impact on the companies that do business overseas, which is practically all of them. So if you like to invest in the stocks like Apple, Starbucks, McDonald's, GM, Nike, Boeing, Tesla, and so many others, their profitability would be hurt because they have significant operations in China, and that would make stocks go absolutely nuts and we'd see a lot of volatility. Now, another potential downside, depending on who you ask, is if the world loses confidence in China's ability to grow their economy, we could see a lot of money leaving China in favor of safer assets that they want to invest their money into. Things like US Treasury bonds, which pay high interest rates and a guarantee return on their money, US stocks, and especially US real estate. Now that is great and amazing for the people that already own those assets, like the billionaires, the multimillionaires, the rich YouTubers, but for the people that haven't had the chance to buy them yet, that would put them so much farther out of reach, which is really bad. Now, I do want to be fair and balanced and show you that there are actually benefits to this as well. Arguably the biggest of which is more manufacturing jobs would return to the US, which would make it less dependent on Chinese labor, and it would make the US economy more resilient. Now, in the short term, this means higher prices. It just does. More inflation, because US workers are more expensive. And if companies have to pay their workers more, they have to raise their prices. Now, some people argue that is a price worth paying for if it means having a future that's more secure with more jobs. Now, if you think about it from all sides though, the downside of doing this is it could speed up automation. As companies rush to lower those costs back down so they could stay competitive in the global market, they would have to increase automation and replace workers with robots and AI. So in the long term, it could actually be bad. Unless, of course, the US finds another partner to trade with and replace China with, which it probably will, like India. Another benefit, though, is that commodity prices like oil, metal, wood, raw materials would go down. Now, that could hurt the people investing in those companies because of shrinking profits, but for the average consumer, that would mean lower inflation because we'd pay less for them. Overall, China's economic slowdown could help the US in a lot of ways, but it could also hurt it too. For every benefit, there's a side effect. The world's economy is connected, and in the ideal world, we would all act in the best interests of the human race. Unfortunately, that is not the world we live in, and there's competition. But my own personal and very limited opinion is that it's probably best to stay balanced and not root for anyone else's downfall, and instead use the opportunity to learn as much as you can about this puzzle so that you can be prepared regardless of what happens. And that's the best I've got, but I'd love to hear your thoughts and anything I might have missed. But as always, focus on your own investment journey. Have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks. Links are down below, and then go track them automatically with the spreadsheet linked down below in my Patreon. Love you. Thank you so much for watching this video. I'd love to see you back here on Monday, Friday, sometimes a Wednesday. See you soon. Bye-bye.